At last class, I explained financial statements. That financial statements are record that business entity are expected to keep, and we look at the important or reasons for financial statement. I think we did that. We look at the component of financial statements. That what are the things that make up financial statement? And I told you that when you hear financial statement, is not singular, it's plural. It means different statement that is being put together to be one. And I told you that the component of financial statements are income statement, or you call it statement of profit or loss account, statement of financial position, statement of changes in equity, statement of cash flow. Now, note to financial statement and statement of financial position. Now, those are the statements that we have, the component, what makes up financial statement. Now, we are now looking at the elements. What are the items that is put together to make this statement? That is what we refer to as element of financial statement. The items that is being combined together that makes up the financial statement. And we have 5 elements of financial statement. 5. We have 1. We have what we call assets. 2 is liability. 3 is equity. 4 is income. And 5 is expenses. These are the items that makes up the financial statement that I have just explained. So we'll be looking at each of these elements. Now. Once we'll be looking at each of these elements. Now let's go to asset. Now, what do we refer to as asset? Now, before I go there, these 3 elements, asset, liability, equity, can be found in your statement of financial position. Why these 2 can be found in your income statement or you call it income statement, can also be referred to as statement of profits or loss. Now, that means you find these 3 elements in your statement of financial position, meaning that these 3 elements, assets, liability, equity, are the items that make up your statement of financial position. While income and expenses can be found in your income statement, or you call it statement of profit or loss account. Now, let's look at each of these elements. Let's look at assets. Now, what do we call assets? Assets, they are resources of a business that provide economic benefit to the business. Am I communicating now? They are resources of the business, of an entity, business entity, that provide economic benefit to the business. Now, let me give you an example why you see assets. Now, if you want to generate income, if any businesses wants to generate, or any entity wants to generate income, what they need is assets. Because just look at it now. Let's say a company, let's look at banks, for instance, like UBA. UBA, they are rendering services, financial services out. One of the assets is buildings, laptops, or furniture. Just imagine that they don't have laptops, they don't have desktop, they don't have building, they don't have anything. Would they be able to generate revenue or income through without those resources? Is not possible. So that's why we say they are resources of an entity that provide future economic benefits. As far as you have an asset, there is a future economic benefit that flows to the entity as a result of that asset. Now, if you have a car, there will be benefit that you are enjoying from that car. Are we together now? That you are enjoying. If an entity have a car, there's a benefit they are enjoying. If they have a building, there's an economic benefit that they are deriving from having those assets or having those resources. And that's what we refer to as assets. Now, we have 2 types of assets. we have two types of assets. So let's look at the two types of asset now. So we are looking at assets. So we have two types of assets. Asset is classified into two. We have what we call non-current assets, and we have what we call current assets. Now, what do you mean by current assets? That's what we want to look at now. What do you mean by current asset? Are we together now? What do you mean by non-current asset? Let's go to non-current asset first. What do you mean by non-current asset? Non-current assets are long-term resources. They are long-term resources owned by a business. That means when we say a long-term resources, they are long-term resources owned by a business. We are saying that is a resources that can be used more than a year. Are we together now? A resources that can be used more than a year is what we refer to as non-current assets. Are we together? That is what we know as non-current asset. It is a long-term resources that is owned by a business and that is not expected to be converted into cash or sold or consumed within a year. Let me give an example now. If an entity should buy a car, you are not expecting that they should sell the car within 1 year. And when it comes to non-current assets, non-current assets cannot be, it is not easily converted into cash. Because before you buy a car, you change the ownership, get this, get that. It is not easy for you to convert it into cash now. Are we together now? That's what we mean by as non-current asset. Non-current assets also have two types of category of assets under non-current assets. What are the two categories? We have what we call tangible and non-tangible assets. Tangible and non-tangible assets. Now, what do you mean by tangible assets? Tangible, when you hear the word tangible, it means that the assets that you can see, are we together now? Or that you can feel. They are physical assets. Assets that you can see, you can feel it, you can see it, you can touch it. They are what we call tangible assets. An example of tangible asset is property, plant, equipment, land, building, machinery, and vehicles. They are example of tangible assets. They are assets that you can see, feel, or touch. That means they are physical assets that is used in the production and supply of goods and services. An example of that is plants, machinery, equipment, properties, land, building, vehicles, cars. They are example of tangible assets. Now let's go to non-tangible assets. They are assets that you cannot see. It does not have a physical. It is not a physical asset. That means it is not a physical asset. Sorry, I mean intangible asset, not non-tangible asset. Intangible asset. Intangible assets are assets that does not have physical characteristics. That means you cannot see it, feel it, or touch it. They do not have. They are non-physical. They are non-physical assets. So example of that, of intangible asset, we have goodwill, patents. The example of intangible asset, we have trademark. Trademark is an asset to an entity, but is an asset that does not have physical substance. We have copyright. Copyright. So we have goodwill, patents, trademark, and copyright. That are the examples of intangible assets. Am I communicating? Now let's go to liability now. Let's go to liability. What are liabilities now? What do we mean by liabilities? Liabilities liabilities, they are present obligation. They are present obligation of a business entity that arise from a past event that in which future economic benefit will flow out of the entity. Let me break it down. When we say it is a present obligation, look at it now. Let's say a company now has not employed let's say has not employed a particular individual. That individual cannot come to that company and be asking for a salary. Am I communicating now? That means I can, as a staff of a company, I cannot go to the company or write to the company that I need the salary of, let's say, June 2026. Have I worked for June 2026? No. Am I communicating now? But if I have not been paid the salary of, let's say, February 2026 now, and I've worked for 2026 February, and if the company has not paid me, that means the company has a present obligation. Am I communicating? Now look at this. Now let's imagine the practical example I used to use to break when it comes to liability out is, let's say you have a child. Now, let's say your child. Now you promise your child that you are going to buy that child a bicycle when the if he takes the first position in the class. Now you now promise that you buy a bicycle for him if he take first position in the class. Now let's say they are preparing for the exam. He now comes, mommy, the bicycle that we want to buy for me. At that moment, you don't have present obligation to that child, because you told that child that once you are after you have sat for your exam, that is when the result is out and you do excellently by coming first in the class, I'll buy you a bicycle. Now if that child now sat for the exam, the result is not hard, now is not disturbing you, mommy, do you mommy, where is my bicycle? You at that moment you say, what are you saying? I can't buy you bicycle now because I've not seen your result. Let's say when the result now comes out and the child now takes first in the class, at that present time you have a liability. And the reason why you have a liability is because as a result of past events, maybe whether whether you have received a services, or whether you have actually obtained a loan, or you have done something in the past that makes you to what, to have an obligation. That means the results of having an obligation must have arise from the what, from past activities. Now when you want to settle that liability, something will flow out of the entity. Now let's say you want to buy the bicycle. Now you can't just go to the bicycle store to buy the bicycle and just pick it up. That means you have to pay for you have to give out something out, a cash, for you to get it. Now that means something has to flow out. This practical example I've made is also similar to what, to companies. That means companies have obligate. When you say liability of a company, it means that an obligation of that business entity that has arisen as a result of past events, in which future economic benefit will flow out of the business. Now that's what we mean by obligation, liability. So let's look at the types of liability. Yeah, let's look at types of liability. We also have two types of liability. We have non-current liability and current liability. So we have non-current liabilities and current liability. Oh, I think I've skipped, before I go there, I think I've skipped what's it called? Current assets. I've skipped current assets. So let me go to current assets. I didn't explain current assets. So let me go to current assets. I just remember now that So what do you mean by current asset now? I've skipped current assets. Sorry for that. Now, what is current asset? Current assets is refers to as short-term resources that is owned by an business entity. What we mean by short-term resources, it means the asset that can be what? That is used or that can be consumed within a year. That is what we call current asset. But those that cannot be consumed within a year or that will consume after 1 year is what, or is fall under what? Non-current liability. But the one that can be consumed within a year, it is under current assets. Sorry, under current assets. Current asset. Now let's look at the example of current asset. I just explained that current assets are short-term resources owned by a business. Am I together? That can be easily, that they are assets that can be easily converted into cash, and that can be consumed within what? Within a year. So it means that current assets can be used within a year. So let's look at examples under current assets. What are the examples of current assets? We have cash and cash equivalent, prepaid expenses, account receivables, we have inventory, short-term investment, and other current assets. Let me explain cash. Cash, the money that the business have at bank, cash at bank, and cash at hand. They are what we call cash and cash equivalent. When we say prepaid expenses, what do you mean by prepaid? Prepaid expenses is under current asset. Prepaid expenses. Now, prepaid expenses are expenses you have paid for, but you have not enjoyed the benefits. That's what we mean by prepaid expenses. Payment that you have made in advance that you have not enjoyed the benefit. Let's give an example now. Let's say I want to go and barb my hair now. I've transferred a cash to the stylist, the hair stylist now, that will help me to cut my hair. Now, that means I have not gone there to cut my hair because I don't have time. Now, what I have made, that payment I have made to that stylist is actually a prepaid expense, is a current asset to me. Is a current asset. That means any payment that I have made in advance that I have yet to enjoy the benefit is what we call prepaid expenses. Are we together now? Prepaid expenses. Payment made in advance. Sometimes we make payment in advance. Maybe a rent, you make payment. Example now, let's say you pay for an house rent for 2 years now. That 2 years, maybe you have not used that 2 years. Those payments that you have made is what we call prepaid expenses, which is also what we refer to as current asset. Now, we still have something we call account receivables. Account receivables or receivables. Account receivables. Account receivables are those debt that your customer are owing you. You sold good to a customer on credit, and the customer are owing you. They are current asset to you. Am I communicating now? It is called account receivables, or you call it receivables. Now, inventory. We also have inventory. I'm just explaining those terms. Inventory. What are inventory? Inventory are assets that are held for sales in your ordinary cost of doing business. Let's say I'm into cars, selling of cars. That means my primary purpose is what? Is sales of cars, to be selling cars. Now, that means my inventory are what? What am I holding that I want to be selling or that I want to be dealing with in my course of doing business is car. That means those cars are my what? Inventory. Let's say someone that is into let's say bakery. That if a bakery now, what will be their inventory will be flours, sugars, bag of flour, bag of sugars, all those raw material that is used to what? To produce bread. They are what we call inventory, because they have to have it in order for them to what? To sell. They are asset held for what? For sales now. Now, let me give you an example. We have 3 types of inventory. We have raw material inventory. We have work in progress, WIP. It's called work in progress inventory. And we have finished goods inventory. What are raw material inventory? Raw material inventory are those inventory that you have, that they are inventory from raw material. Let me give an example now. Let's say you want to produce what's it called? Let's say you want to produce blocks. We are into production of blocks. So cement, sand, water are your what? They are your raw material. So the value of those things are what we call what? Inventory. It will not be raw material inventory. Now, work in progress inventory are inventory that are not that are yet to get to the last stage of production. Am I communicating? Let's say you want to produce a let's say let's say you want to produce a car, but that car has not got to the is yet to reach the last stage of production for it to be called finished product. So at that stage they will have a value even though they are still work in progress. Those are what we call work in progress uh, inventory. WIP, work in progress inventory. Finished products, finished goods. Are we together? Finished goods inventory are inventory that are what? That have passed the last stage of production and are ready for what? For sales. The value of those items will be considered as what? It is considered as finished goods inventory. Am I communicating? We also have what we call short-term investment. Investment that are within what? A year. They are also under current assets. The example of current assets. So under current assets, we have cash and cash equivalent. We have prepaid expenses, account receivables, inventory, short-term investment now. So that are what are under your current assets. So let's go to liability now. Sorry. Let's go to liabilities now. Now I was explaining liability the other time. So we have liability, and I explained that liability before I skip a current asset. So I explained that liability is refers to obligation, our obligation of an entity as a result of past events in which future economic benefit will flow out of the entity now. So they are obligations that are owned by the what? By the business entity to others. What are they? Did they take a loan? Am I communicating? Are they here to pay salaries? Are they owing salaries? They are what? Obligation that the business owns to others now as a result of past events. And liability can be categorized into two. We have what we call non-current liability and we have current liability. So let's go to non-current liability. Non-current liability are obligation that an entity has to settle over a year. That means an obligation that you have that you can settle it over a year. After a year, it is what we call a non-current liability. Non-current liability. So let's look at example of non-current liability. We have long-term debt. You know, a debt that you will settle more than a year, maybe 2 years, 5 years, 7 years, 10 years. They are under non-current liability. We have bond payables. You know, bond, that means that's debt security that a company issue in order to get funds from outsiders. That is after a year. So bond repayment or bond payable is also under non-current liability. We have deferred tax liability. You know, they are assets that you will be paid in the future. They are taxes that you will be paid, that will be settled in the future. They are called deferred tax. That means more than a year. Are we together now? That's what we call deferred tax liability. And we have pension liability. Maybe your staff that are working for you now, you now determine how much you are going to pay them when they retire, maybe, and that will be more than a year. Am I communicating? It is under long-term liability. They are pension liability are obligation to pay a future retirement benefits to employee. They are under long-term liability. Now let's go to current liability. Current liability are obligation of a company that is expected to be settled within a year. So when you hear within a year, you should know that it's current within a year. So what are the examples under current liability? We have account payables. Account payables. Now, what do you mean by account payables? Account payables are those money that are owing to your suppliers. It's not like account receivable that your customer is owing you. When you hear account payable, it means the amount that you are owing your suppliers, that the company is owing the supplier. Maybe the company bought goods from their suppliers on credit, so they are owing their suppliers. So it is called account payables. So we have short-term debt. Short-term debt are those loans or those borrowing that you have obtained that will be settled within a year. Let's say you collected a loan and that loan will be settled within a year. It is called short-term loan. It is not long-term. Long-term is under non-current asset, but short-term loan is debt is under what current assets. We have accrued expenses. Let me explain what accrued expenses. What is accrued expenses? Accrued expenses are the expenses that the entity has enjoyed, but they have incurred, they have enjoyed it, but they are yet to pay for it. Let's say your staff have worked for a particular month now, you are yet to pay them, maybe 2 months, 3 months. They are what we call accrued expenses. Am I communicating? That's what we call accrued. Maybe someone helped you to, maybe someone was employed or was contacted to repair something for a company, and he has done that repair, and the company is here to what? To pay him. That is accrued expenses. They are expenses which an entity has incurred or enjoyed the benefit, but they are here to pay for it. And we also have what we call income tax payable. Income tax payable is not like the VAT tax that will be paid in the future. They are taxes that you are here to what? To pay government now. Am I communicating? They are current tax liability that you are owing that you are owing government now. It's not like the VAT tax liability under long term liability now. So these are examples of current liability and non-current liability which we have looked at. So let's go to equity. Equity. Don't forget that this first three is under statement of financial position. So let's go to equity. What is equity? Equity represent the owner residual interest. That means equity is a residual interest in the asset of a company after deducting liability. So it means that when you say equity, equity is the residual interest. What do you mean by residual interest? It is what is left after you have deducted your liability from your asset. Whatever is left is what we call equity. And equity, that's why equity is called residual interest. Residual interest in the asset of the company after deducting liability. So let's go to examples of equity. We have common stock. Common stock. We have preference stock. Preference stock. We have retained earnings. We have pay up capital. We have treasury stock. So let me go to common stock. Common stock is what we call ordinary share capital. It is called ordinary share capital sometimes. They are basic ownership interest in the company. When you want to be part of the owner of a business, especially when it comes to public limited liability company, you buy shares, and that shares will make you to be entitled or to be part of the owners of the business, and that's what we call ordinary shares or common stock. We have preference stock or what do you mean by preference stock? They are like, it is similar to common common stock or ordinary share, but they have more privilege. They have more priority than common stock. Maybe if they want to pay dividends, they will be the first set of people that have common preference stock, or we call it preference shares. They are those that will first be settled before any other investor. So they have priority. They are given priority over ordinary shareholders or common stock. We have retained earnings. What do you mean by retained earnings? Retained earnings is just the accumulated profit. Let's say a company now, they are making profit. That means any profit they make in any year, they will be what? Taking it to retained earnings. So that's why we say retained earnings is the accumulated profit. That means the profit that the company is owing, that is making over the years, will be what? It is what makes up the retained earnings. Let's say a company in 2024 makes 1,000 naira. In 2025 makes 2,000. In 2026, let's say the company makes 500 naira. That means if they ask you what is the retained earnings of the company, what will be the retained earnings of the company will be the addition of all the profit that has been made, and that will be 3,500. Are we together? And it is out of retained earnings that you pay dividends. That means dividends is the reward of shareholders in a company. Dividends is the reward of a shareholder. That's why you see that every year or annual basis, companies declare dividends, and they pay dividends to the shareholders. Shareholders are the owner of the business, especially for public limited liability companies. So they pay dividends to them. So if they want to pay dividends to shareholder, they pay it out of retained earnings. Am I coming? They can decide that, okay, we want to pay dividends of 2,000 naira. So dividends of 2,000 naira will be paid out of the retained earnings. And let's assume dividends of 2,000 naira was paid out of 3,000. They have a retained earnings of 3,500. What will be now be retained earnings? The retained earnings will now be 1,500. So I'm just making an example. So the accumulated profit of the retained earnings is the accumulated profit of a business, and which dividends is paid out of the retained earnings now. So I've explained that. Another example is call in capital. Call in capital is also one. The amount paid by investors above the par value of stock. This additional call in capital is also called your share premium. It also refers to as share premium. That means, let's say the value, am I communicating? Let's say the value of a share is 1 naira, but when you buy the share, you bought it at 2 naira 50 kobo. That means you have paid more than the nominal value. This is the nominal value. This is the nominal value, and this is the selling price. So you have paid more than the nominal value. So how much have you paid more than the nominal value? So it will now be 2 naira 50 kobo minus 1 naira. What will you have? That will give us 1 naira 50 kobo. So this 1 naira 50 kobo is regarded as additional pay in capital, which is also called share premium. Share premium. Share premium. So these are examples of equity. So example of equity, we have ordinary share capital, which is also called your common stock. We have your preference stock, which is also called preferential preference shares. We have what we call retained earnings. We have revaluation surplus is also there, which is not in the material. Revaluation surplus. We have share premium, which is called your additional call in capital. These are examples of your equity. Don't forget, I told you that equity is the residual interest in the asset of a company after deducting liability. So if you want to find your equity now, example, if you want to do it mathematically, so your equity will always be assets minus what? Liability. This is the mathematical illustration of equity. So if your asset is 20,000 and your liability is 7,000, so that means your equity will be 20 minus 7 will be 13,000. That means your equity is 13,000. Why? Because that's what is left after liability has been deducted from your asset. That's the mathematical illustration of equity. Now let's go to income. Now we have mentioned that when it comes to assets, liability and equity will be found in your statement of financial position. Assets, liability and equity will be found in your statement of financial position. Now let's move forward now. So let's now go to the fourth element, which is income. Income. What do you mean by as income? Income arises from business from business ordinary daily activities. That's when you make income. Let's imagine now you are into sales of car. The money, as you are selling the car, you'll be making money, will be coming in. Am I communicating? Money will be coming in into the business now. That's what refers to as income. Are we together? Now that's what refers to as income. That's what refers to as income. Are we together? Now, if you want to explain in accounting terms, income is when there is increase in assets and decrease in liability. That's it. When there is what? Income can also be referred when there is increase in assets or when there is decrease in liability. So let me explain what we mean by that now. What we mean by increase in assets, let's say you bought something for 5 naira and it increased to 5 naira and it increased to 7 naira. That means it has increased by how much? 2 naira. That 2 naira is an income to you. Am I communicating? That 2 naira is an income to you. Are we together? Now, let's say you have a liability, decrease in liability. You are owing someone, let's say 5,000 naira. And the person now say, okay, if you are able to pay within 30 days, I will reduce that 5,000 naira by 10%. So you pay 10% to me if you have to pay, if you pay it within 30 days. That means if you now pay that money, it will reduce it by 10%. 10% of 5,000 is how much? That's 500. So you pay how much to the person now? You pay 4,500. That means you have reduced your liability. You are supposed to pay 5,000 naira, but you are paying 4,500. That means that 500 naira in which your liability has increased, reduced, is an income to what? To the entity now. That's what we mean by income. Now we have two types of income. We have what we call revenue and gain. Now, as I was explaining, I say income is the what? Is the increase in what? In assets and decrease in liability. Am I communicating now? Now, let's say your revenue. We have two types of income. We have revenue and gain. Now, what do we mean by revenue? Revenue, they are income that arise from your ordinary cost of doing business. Are we together? They are your income that arises from your ordinary cost of doing business. Let me explain now. If a business, let's say I'm into educational services now. That means all the tutorial fee being paid to me, they are my what? They are my revenue. Are we together? Because my ordinary cost of doing business is to provide what? Educational services. Are we together now? Now, let's say those that are into providing accommodation services to people now. That means rentage income. That means all those money they collect from rentage is actually is a revenue to them. Why is it revenue? Because their ordinary cost of doing business is providing accommodation services. Am I communicating? So revenue arises from the business ordinary cost of doing business now. What is their ordinary cost of doing business? Whatever they are getting is what we refer to as income. Let's go to gain. Gain are income that are not directly related to your ordinary cost of doing business. Let me give an example now. I'm into let's say I have a schools and I'm providing educational services. Let's say we now sell one of our school bus and we now make profit from it. Now, what the sales of that school bus, because our ordinary cost of doing business is not to sell car. So, but we have made profit from the sales of car. So it will not be regarded as revenue. It will be regarded as what? Gains. Because that income we have derived from that act is not directly related to our main cost of operation or our primary cost of doing business. And that's what we mean by gain. So let's move now. Let's go to expenses now. What do you mean by expenses? Expenses. Expenses are the cost or the outflow of money incurred by a business or an organization. Let me give you an example. In order to acquire goods and services. That means those things or the cost that you incur whenever you want to provide your services or whenever you want to maintain your assets or fulfill an obligation is what we call expenses now. So, but let me now give you the accounting definition of expenses. Expenses will arrive when your assets decrease is just the opposite of income. Decrease in assets and increase in liability will result to expenses. Because whenever this occur, that means you will incur a cost or an outflow of money will be incurred by the organization. Now, let me give you an example now. You bought something worth 5,000 naira, but let's say the value now, the value of that item now is now, let's say, is now 3,500. That means something you bought 5,000 naira is now worth, let's say, an asset you bought, maybe a land, you bought a land worth 5,000 naira, is now worth 3,500. That means it has reduced by what? By 1.5. That 1.5 is a cost that you have incurred. That's what we call decrease in asset. Or let's say you have a liability, and that liability now, because of default now, something that you are supposed to pay 6,000 naira for, because of you have defaulted in the payment now, let's say the payment now increased from 6,000 naira to, let's say, 6,500. That means the liability has increased, and because the liability has increased, you have incurred a cost of additional cost of 500 naira, and that's what we mean by expenses now. So let's go to examples of expenses. We have operating expenses, those costs that you incur on day-to-day operation of your business now. Office supply, you have to buy paper, you pay salary, you pay rent. There are examples under operating expenses. Am I together now? We have personal expenses, we have fixed expenses, and we have variable expenses now. But don't forget that I just inform you that income and expenses will be found under which statement? Under statement of profit or loss, or statement of profit or loss can also be referred to income statement. So let's go to accounting equation. Now, when we say accounting equation is just is used to explain the statement of financial position. I told you that there are 3 items of financial statement, or 3 items under statement of financial position, namely assets, liability, and equity. So this accounting equation is used to explain these items under what? In statement of financial position. And what is the simple what is the formula for the accounting equation? Accounting equation is denoted as this: asset is equals to equity plus liability. So when you add your equity and liability together, you will have your assets. Am I communicating? Now, don't forget, your equity can also be referred to as what? Capital. So in the exam, you may see equity or they may write capital. It means the same thing. I told you that equity is what we call what's it called? Share owner's worth. are the resources contributed by the owner. Are we together now? So you may see asset is equals to capital plus liability, or you see equity. So it's the same, please. Now, that means if you are given asset and they say you should find your equity, how will you find your equity? It means that liability will come to this day. You will now have asset minus liability equals to what? Equity. So that means your equity is what? Equity is equals to assets minus what? Liability. Am I communicating? Are we together? Now,
yes, we are together.
Now, if you are asked to look for your liability, now how will you get your liability? Your liability, that means you want to get your liability now. That means equity will cause the equation sign. So when it comes to the equation side, it will become minus. Minus what? Asset minus equity equals to what? Liability. So your liability is assets minus equity. Are we together now? So it depends on what you are asked to find. It depends on what you are asked to find. Now, are we together? Now, also your equity can also be referred to as your net asset. Please note that. Equity also represents net asset. So is that you call your equity can be referred to as capital. Equity can also be referred to as net asset. And how do you find your equity? Equity is what? Asset minus liability. Please note that. Please note that. So let's move forward. Now let's go to another equation now. So let me give an example now. Let's give an illustration before we go to the example now. Let's say you are given an asset of 100,000 and you are given a liability of 25,000. They now say, what is your equity? You don't know your equity. So you just go to accounting equation, which is asset is equals to what? Equity plus liability. So your asset is what? 100,000. Why your equity we don't know it? So let's equity be what? Be X. So your equity is X. Liability is 25,000. So collect items. So it means we have 100,000 minus 25 equals to X, which is your equity. So your equity will be 100 minus 25,000 naira will be 75. So your equity is 75,000 naira. But I can assure you that in the exam, they may not give you something like this. They may not give you directly like this. So they may give you the items under assets. You will need to add those items together. Let me give you an example now. So look at this now. He said your plant is 100,000, cash 25,000 naira, accrued expenses 5,000 naira, inventory 20,000 naira, payables 10,000 naira, bank loan 2,005. They now say find equity. So let's go to accounting equation now. That means our equity, our accounting equation is asset equals to what? Equity plus liability. So equity now, based on what we have done earlier, so I don't need to be, is assets minus liability. But are we given our total assets here. We are not given this question. So we need to gather all the items under what? Asset together. So let's look for our asset now. Let's classify it to know our asset and our liability, so that we can now use it to what? To calculate now. Plant, is it an asset or liability? Plant, is it an asset or liability? Plant, is it an asset or liability?
It's an asset.
It's an asset. So we have plant, how much? 100,000. Now cash, is it an asset? Yes.
Asset.
How much is it? 25,000. Accrued expenses, is it an asset or liability?
Liability.
So thank God you know that. So accrued expenses, how much? That's 5,000. Now inventory, is it an asset or liability?
Yes, asset.
Asset. So we have inventory. How much is it? 20,000. Payables, is it an asset or liability? It should be an asset, right?
I think so.
It's not. You got it wrong. I got it at this moment. Payable is liability. We talked about payables now. We talked about account payables. The payables are the money that you are owing, the amount that you are owing your supplier. That you are owing your supplier is payables.
Okay.
Or the amount that you are owing outsider is called payables. So how much is it? So it's liability, 10,000.
10,000. Bank loan.
Bank loan, is it an asset or liability?
Liability.
Yeah. 25. You got that one. But I got you this time. I got you on payables. How much is that? 2,005. So let's add it together now. So we have 100,000 plus 25,000. That's 125 plus 20,000. That's 145,000. Now that's the total. For payables now, for liability we have 5,000 plus 10,000. That's 15,000. 15,000 plus 2,005. That's 17,500. So we can now solve using this accounting equation now. Am I communicating? We cannot solve using the account. So our equity now. What's asset? Asset now is 145,000 minus 17,500. What do you have? What do you have? Very quick one, please.
127,500.
127,500. 127,500. So that will be your what? Equity. Can you see now? So you may be giving something like this in the exam that you need to classify which item is under asset and which one is under liability. So I'm going to give you an assignment actually. So there are some, when we are explaining accounting equation, basically is mainly to what? To explain statement of financial position. So to explain equity, liability, and asset, how they relate. So let's now go to accounting equation based on revenue now. Now let's go to, so we have net income. Net income is revenue minus expenses. So when you remove your revenue from your expenses, you have net income. Am I communicating now? Now, also this formula can be changed. You may be asked to calculate your gross income. So how do you calculate gross income? Gross income is revenue minus cost of goods sold. That means the cost of the goods that you want to sell. You remove it from your revenue, you have your gross profit. Am I communicating? Now there's something we call operating profit, operating income. Operating income is when you remove operating income is your revenue, your gross profit gross profit minus operating expenses. Are we together now? Now we have net income. Now we have calculated net income now. That means net income can also be recalculated or can be calculated as your operating income. Am I communicating? Operating income. So you can also calculate your net income. Your net income can also be calculated as operating income plus non-operating income. That means those income that are not related to your operation minus non-operating expenses. Are we together now? Those are what we refer to as your net income. So your net income can either be calculated as your revenue minus your expenses, or net income can be calculated as your operating income plus non-operating income minus non-operating expenses. So whatever you have here, you add it to your operating income. So let's look at this illustration now. Let's look at this operation now. Let's look at this calculation. So we are asked, so we are given an information like this as follows. So let me just leave this on the board. So we are given, so let's look at this question. Let's look at these two, use it to extract we use this information to do some calculation or to ascertain some items based on the formula we have done now. So let's say we have your revenue 200,000, your cost of goods sold 50,000 naira, your operating expenses 40,000 naira, non-operating income 50,000 naira, non-operating expenses 30,000 naira. Now you are now being asked to now use it to calculate your gross income. Let's say your gross income. You are now asked to calculate your gross income based on this information. How will you calculate your gross income? Don't forget the formula you have been given concerning your gross income. They say gross income is what? Revenue minus cost of goods sold. So what's your revenue? Your revenue is 200,000 based on this information. Why? Your cost of goods sold is 50,000 naira. So when you remove it, your gross profit will be what? 150,000. Am I communicating? Now let's now be asked to calculate your operating income. You are now being asked to calculate your operating income. Don't forget the formula for your operating income. Operating income is gross profit minus operating expenses. Are you giving operating expenses? Yes, 40,000 naira. And in this question, you have not been given your gross profit, but we have calculated our gross profit. So you need to calculate your gross profit first before calculating your operating income. So let's now calculate our operating income now. So our operating income will be gross income, which is 150,000, minus 150,000 minus, which is our gross profit, minus what? Operating expenses of 40,000 naira. So our operating income will be 110. Now let's say you are being asked to calculate what's the operating expenses. Yes, there was a mistake there. Now let's now be asked to calculate our net income. Our net income. We are not giving our expenses directly, our total expenses. We are not giving the total expenses directly. So the formula we use is this formula. because we are not giving directly our expenses. So it means that our net income, don't forget I told you that you can use two formulas depending on the information you have been given. So we know our operating income now. So we know our operating income. What's our operating income? We have calculated it to be 110 plus non-operating income minus non-operating expenses. So our non-operating income is 50,000. So 50,000 minus non-operating expenses of 30,000. So when you remove 50,000, when you remove 30,000 from 50,000 naira, you are going to have 20,000 naira. So you add it. So 110 plus 20,000 naira. So 20 plus 110 will give us 130. So our net income is 130,000. Are we together? Are we together?
Yes, we are together.
Okay. There's a mistake. There's an error in that material. Please look at it. They made a mistake when they were calculating what's it called? Your operating expenses. They went to go and pick. Okay. Okay. Operating expenses was 40,000 naira. They now pick 30,000 naira. So that's where the mistake is in your material. So if you go to your material on page 46, you see that mistake. So instead of your operating expenses supposed to be 40,000 naira, but in the solution, they now wrote 30,000 naira there. So that's the reason why you are seeing differences on what I'm solving on the board and what is on the material now.
All right.
Yeah.